You go 2 or 3 weeks, and every day is $20, $30, $50,
Up.
$120 up.
Up.
You just think, this is relentless. Where does it end?
Right.
And then it does end, and it's either the very end of a bull market or it's in an interim phase. And yeah, I think we are, in fact, in the interim phase, third, fourth inning. But thank you. It's about time. 10, 15% lower for gold and silver. That's in the category of a gift. That's how I would see it. And we're most of the way there already, that it moves fast. And by the way, counter-trend moves tend to do that. They're grinding one direction, and they're sharp and short the other direction.
And that's what you're expecting at this point. You know, after listening to Morgan Lewis talking both at the MWM meeting and even this morning, we realize that we're seeing a major regime change in the monetary system. So I would imagine your central banks, which have been pushing this market up, are probably going to be buyers after this correction again.
And I think metals are in the early stages of being normalized as an asset class amongst global investors as well. So, that it is taking a pause does allow for investors to step in. And again, the normalizing of the asset class is pretty important. It's something that's pretty new to most investors. September ETF flows show that investors are beginning to take an interest. But yes, it is time for a correction.
Yeah. Well, and the other thing that you've been watching is the outperformance of silver relative to gold. That ratio, we started to see silver outperform, and you started realizing that was going to change the market a little bit.
Well, and we suggested this at the beginning of the year, that you would see confirmation of a bull trend and an entrance into an acceleration phase when mining stocks outperform the physical metals,
right?
When there was an increase in ETF flows, and when outperformance of silver relative to gold occurred. We've had all three, which is supportive to the long-term bull case, though, again, I would be more enthusiastic if the gold-silver ratio could break out of the 80s. It did so for a nanosecond last week, but has since returned to 85 to 1 this week. By the middle of next year, I think it will be in the mid-60s on the ratio.
Well, and just for the record, for those who are watching this, you actually started the recording late this morning because you moved some of your gold over to silver when the ratio hit that number. But
that's right. But I'm also grateful that I've got a vault plan in the vaulted program, and the time that it took for one trade to settle, all I had to do was refresh the page, settled, and then I went back in and purchased the silver. Refresh, settled. There I have my new ounces in silver. So, it was this morning, as a matter of fact, was the deposit. Yesterday was the deposit into my vaulted account, and the trade settled this morning at lower numbers, which I was grateful for.
Right.
Last
and then
month
you moved over to silver after that, right?
That's right.
Yeah. Well, it's probably important, too, as we go through these corrections, to go back and review the bigger picture. And Morgan's Hard Asset Insights, Morgan Lewis's Hard Asset Insights on our website, is something that our listeners can read every Saturday morning after he posts them on Friday.
I would encourage this weekend's missive is sort of a must-read for perspective on how we see the unfolding bull market in metals. And I in fact, encourage might be too soft. I insist you take the time to read Morgan Lewis's Hard Asset Insights this weekend. Nothing short of a structural monetary regime change, unlike anything we've seen since 1944 and the creation of Bretton Woods. It has positive implications for the precious metals for years to come. Not so positive if you're looking at our currency. But Morgan shares the highlights from our investor conference in this week's HAI. You won't want to miss it.
Okay, so let's say we get a 5% correction, say today or tomorrow. What are you looking for? What would be typical on a correction after seeing what we've seen with gold, if it can be stated?
Yeah, well, first of all, I think your core position, you sit tight, you add on a correction for latecomers to this bull. It's just helpful to know that a 10-15% correction is in line with historical upside pressure alleviation. Things run and run and run, and it does pause. And so this is a super healthy thing. Morgan ties together the policy inclinations of the current administration, which are explicitly dollar negative, and driven by a combination of industrial policies, debt alleviation via inflation. Uh, so again, in the broader context, a very strong support for the metals, a 15%, a 10% correction. Likely, I think that's at the front edge of a broader market decline, thinking of the S&P and the NASDAQ, for instance. And this is where you look at risk assets, and risk has been ignored. It won't be ignored forever. And there are times in the last 20 years where gold was at the front edge of a broader decline. And then all of a sudden people rethink risk and clamor back to own gold shortly thereafter, while you have the remainder of decline in your equities.
I've got a question for you. You just came back from a conference and you were speaking to a group of people who are relatively informed investors. Was there an awareness of the gold market at this time?
I had assumed, given the degree of education and the involvement in their direct asset management, that they would have understood the gold market very well. So I spoke to a group of 400 to 500 investors. This was last week. And so I dived right into portfolio composition and precious metals trading strategies and the best way to navigate the metals market.
You were assuming that they knew what you were talking about.
I was assuming that they understood why gold and silver. The why, I thought was obvious. I mean, we're well into a bull market. If this is third or fourth inning, this is not the fresh first pitch of the game. What don't you know? Of course you understand this.
One of the top performing assets in all of the asset structure.
Arguably the top performing asset. I mean, you've got miners up 130%. You've got in a range from 60% for gold, over 70% for silver, 80 to 83% in the platinum group metals. Yeah, obviously prior to the correction. But this is what I was sharing with him last week.
Right.
And there was this dumbfounded look on their face. So 53 years has taught us a few things. I was trying to distill for them, more of the why us than why gold, because there is a healthy way to navigate these markets, and to be able to compound ounces takes the proper portfolio composition on the front edge.
And a little historic knowledge.
Yeah. So metals hit an all-time high last week, retested those highs yesterday for a nice double top, and across the crowd, there were only a few that knew anything about it.
Isn't that typical? The thing that's amazing is gold is in the news now, yet people are still giving you blank stares.
Yeah, so where are the metals trading? Blank stares. What are the returns year to date? Blank stares. Interest in crypto? Off the charts. Interest in real estate and a host of other highly illiquid assets? Very interested, and that set the tone for every conversation. It was absolutely fascinating. Only one conversation at this conference stood out. A corporate credit analyst in the audience, concerned about market liquidity, flipping fast in the months ahead, very aware of the metals market. And he's also a routine reader of the Credit Bubble Bulletin.
Well, there you go. No wonder.
Risk awareness was otherwise very low. And it makes sense that gold was not on their radar, because they're not thinking about risk. They're not thinking about wealth insurance. And plain and simple, that's what metals are, is wealth insurance. You tell me if risk, the awareness of risk, is priced into the financial markets today.